The broadcast is now starting. All attendees are in listen.
Good morning, everyone, and welcome to this OMFIF webinar presenting the Barclays Africa Group Financial Markets Index 2017. My name is Danae Kyriakopoulou, and I'm Chief Economist at OMFIF, and I'm joined by George Asante, Managing Director at the Barclays Africa Group. Welcome, George. Just before we start, we will go through some of the logistics in terms of how you can participate in this webinar. So on the right-hand side of your screen, you can see a section with questions. So that's where you can send through your questions as we go through the webinar. We will then collect some of these questions and respond to them at the end of the session. Please also note that this webinar is on the record, so feel free to tweet or share any findings that you find interesting throughout the course of this webinar and report on it afterwards if you wish to do so. We will also be conducting some questions to you, to the audience, as we go through the webinar to get your views on what our findings say. And without further ado, I will hand over to George to introduce us to the index and give us some more information about what is the background to the index, why we've done it, what are we trying to achieve with it. George, over to you.
Thank you, Danae, and I would like to say a big thank you to all who have dialed in. In his foreword on the launch of the index on the side of the IMF meeting, Dr. Adesina Akinwumi, the president of African Development Bank, wrote a note to us, and in the note he made mention of the fact that African markets have been quite resilient since 2008 after the global recession, and the various markets have really been able to withstand various challenges that were posed by the recession that the world faced. But he also noted that the markets have remained fragmented and shallow if you compare African markets to the equivalent in Latin America and Asia. This is a view that we believe is true, and we tend to agree with Dr. Adesina that a more open and transparent market across the continent will ensure that Africa stands in a position to attract its fair share of global capital, both from domestic investors and also from international investors. We believe this is something Africa has not been able to achieve over the years. On the basis of this, and also in line with Barclays Africa's shared growth strategy, we have partnered with OMFIF to undertake this work. And we believe that OMFIF is a very important partner to this whole research work that has been conducted, because they bring an independent lens to examining the real state of African financial markets. We intend for this to be an annual publication. And just to give you a bit of insight into how the inaugural session actually went, we believe that the inaugural session was quite well attended by various people, from central bank governors to ministers of finance to chief executive of African exchanges, various regulators. We had people from AFDB and the IMF. We had academia, institutional clients, and corporate clients. In the maiden form of the index tends to assess the financial markets of 17 African countries on 6 major pillars and with 70 sub-pillars. The goal of the index really is to offer us all a tool, particularly interested participants in the financial market, that will benchmark areas where different countries in Africa are excelling from a financial market development perspective. And the intention really is that beyond the insights that are offered by the index, the intention is to achieve a faster rate of reform across different countries from a financial market perspective. And we believe that the index will also become a tool that will track the various initiatives that different countries have undertaken with regards to the financial markets. It's quite interesting to say that since the launch of the index, we've had overwhelming support from different stakeholders from across the continent. And the key findings from the index beyond the IMF meeting was also a big topic at the G30 Global Leaders Summit. Additionally, I mean, as a lot of you will know, we've received some extensive coverage in the media as well. And I would like to end by saying that in the coming months, between ourselves and OMFIF, we'll be moving from country to country and meeting different stakeholders, including regulators and participants in the financial market, to launch the index in the various markets and have deeper conversations and also get input in how we move this index forward and use it as a tool for what we wanted to achieve. So at this point, I would want to hand over again to Danae, and I want to say that we thank you once again for dialing in, and I hope you enjoy.
Thank you, George. So this is a very useful background as to why we're doing the index, how are we engaging with the countries in the region in terms of using the index as a practical tool for improving and helping develop Africa's financial markets. But what does the index actually say? This is the first year that we've done the index, so the results are a benchmark at this stage, and as we do the index in following years, we will use this year's result to see how countries have developed, how indicators have changed, how performance has improved or deteriorated in some cases. So in this first year, what we see in the results is in the broad aggregate index that is a build-up of several indicators. The results are in some extent what you would expect. So you see South Africa, the continent's most developed economy, being at the top with a score of 92 out of a maximum of 100. You see Ethiopia at the bottom, an economy that does not even have a securities exchange. And at the top, you also see your usual suspects like Mauritius, Botswana, Namibia in the top 4, economies that are very well developed and have had development of their financial markets going on for some time. This to us is not really the headline findings of the index. What we see as more important is what is happening in the middle as well, because there is a limited number of ways that a country can be at the top. South Africa has scored the best out of all the pillars that we have in the index. Ethiopia is towards the bottom at all of the pillars, but there is various ways that countries can be in the middle pack, and that's what's interesting to see. Why is Ghana at number 7 and Morocco at number 12? Why is Uganda at number 10 and Tanzania at number 11? What are the sub indicators that cause them to have that score? What are the pros? What are the cons in their financial markets? And the way the index is structured is that it is based on 6 pillars. So we look at market depth, at access to foreign exchange, at market transparency, the tax and regulatory environment, at the capacity of local investors, at macroeconomic opportunity, and finally, pillar 6, at the legality and enforceability of standard financial markets master agreements. And there we see some more variation in terms of how countries perform. There are some pillars, and all of the pillars have various sub-indicators going in all of them, and we will go through these throughout this webinar. But broadly speaking, some of the pillars see greater variation than others. Some other pillars are more equal in terms of how countries perform. But overall, the pillar where all countries tend to do best is the one about market transparency, tax and regulatory environment. There is very good scores there, and it's not a case of South Africa being at the top and then after that it goes down very quickly. We also have high scores for Mauritius, for Nigeria as well. Rwanda does very well at that pillar, and even Ethiopia gets a score of 20, which is one of the highest one for the bottom country that we have across all the pillars. And this is interesting and important because it is about the infrastructure for financial markets. So the market transparency, the tax and regulatory environment, it shows that the practices are there, they are in place, But what the fact that other pillars are not as strong shows is that despite having a relatively better regulatory and tax environment and market being very transparent, that does not quite translate into results such as capacity for local investors, for example, which is one of the worst performing pillars. You have South Africa with a score of 100 and Namibia with a score of 94, and after that it goes to 49 for Botswana. So it drops quite quickly after that, and the overall average for this pillar is quite low. Macroeconomic opportunity is a pillar that is fairly less skewed. The average is closer to the median there, and we have South Africa getting a 73, so it's not very skewed. And again, macroeconomic opportunity is not just about macroeconomic prospects, it's also about the level of development, and we will go into that in some more detail later on. Again, market depth, it's very skewed. Access to foreign exchange is a little bit less skewed. And these are the 6 pillars that we look into. And the spider diagrams that you can see in the slide in front of you show how each country is distributed its scores according to these 6 pillars. So we will move on to discussing each pillar one by one, and I will pass on to George now to take us through the first 3 pillars, pillars 1 to 3, and we will also be running some polls to get your view on how you see the performance of these markets across these pillars as we go along.
Thank you very much, Danae. So on the first pillar, we try to measure the depth and breadth of each of the markets, and we focus on a couple of sub-pillars to really tell us the story about how deep and how broad the different markets in Africa are. And it's important to note that what we've done is not restricted to a particular market. In fact, we scan the whole range of different sub-markets within a financial market. So information that was gathered to arrive at a rating for each of the countries cuts across the equity market, the derivative market, the money market, the repo market, the FX market, etc., etc. So it's really all-encompassing, and it tells a one-stop picture of the state of the different markets. I mean, if you look at it, and again, we are not surprised by South Africa that is at the extreme left and is leading with almost equal to the highest mark that you could have for this particular pillar, followed by Mauritius. I think the telling story really is the gap between South Africa and Mauritius. That is a massive gap. It's about a 200-point gap. And then if you look at Mauritius and all the other countries, it's really clustered. Which then tells you that most of the African markets are almost at the same level of market depth. I mean, if you want to call it that. And then the picture also tells you something about the fact that almost every market has a form of financial market. So it looks like the base of the financial markets have actually been established across all markets, including Ethiopia. What you then lack is the liquidity that comes or must come through the market. And without liquidity, you can't actually build your product base, right? So it also demonstrates the linkage between liquidity of base markets and how that leads to different markets. And I think for us, it's quite important for this point to be highlighted to different stakeholders that to really build a strong financial market, you need to build the building blocks. And the building blocks have to be with the base product. The base products are the spot product, the cash product, etc., which in almost all the African markets, with the exception of South Africa, almost every other market struggles to actually meet the benchmark from a base product liquidity perspective. If you move, the slide we're looking at currently, it also tells quite an interesting story in terms of how much of the local exchanges, how much of it is actually turned over from a liquidity perspective. And there again, you can see South Africa actually standing out. But before that, you can see that the market capitalization of a country like South Africa and the next one being Botswana is quite significant. If you strip that out of the pack, you actually get a very poor market capitalization to GDP. The total or the average for all the other countries, excluding South Africa and Botswana, is around 27%, which is quite poor if you look at it in the context of where South Africa is. It's important to also explain that the situation with Botswana has to do with a few large global corporates that are listed on the exchange, and beyond being listed, and if you move to the next line or the next column or the third column, actually looking at the second and third column, you can actually see that even though Botswana has a massive market capitalization to GDP, when you go to the liquidity and the churn of the market, is basically non-existent. And it also throws a question about the activity of market makers probably in these different markets. It appears that beyond South Africa, there is no real market maker in the various markets. And therefore, we are not seeing the churn that should really come through with the listing of stocks on the different markets. If you move to Pillar 2, it talks about capital control. And I think it's important to also explain that this capital controls may not be that relevant to a local investor, but it's quite critical to foreign investors. And I think from our opening statement, we actually made mention of the fact that Africa needs to attract both local and foreign investment to be able to develop. And therefore, you need to look at the needs of the local investor and the needs of the foreign investor. One of the things which is a big worry for foreign investors has been the issue of capital controls and the environment surrounding their ability to access FX liquidity when they need to access FX liquidity. So again, if you look at the chart, it tells a very interesting story. The first point to make on this chart is the fact that from an official exchange rate observability perspective, almost every country has an exchange rate that can be observed. Now, when you go to the next level where you start talking about interbank liquidity, so I can observe my market or I can observe your market, but is there liquidity for me to transact that observed price? There doesn't seem to be liquidity to facilitate any transaction that I may want to do in that market. And that then becomes a problem. And one of the reasons why there is not much liquidity could also be attributed to the various capital controls that are in place in the various markets. So in most markets, you can observe the price, but the price may not necessarily reflect where a willing buyer and a willing seller may be transacting in a financial product. And therefore, it becomes a problem because I can observe, but I can't trade, and therefore my liquidity then goes, the liquidity is not as significant as I would want it to be. So I think for one point to make is that observability of pricing is very important, especially FX, but we need to go beyond that observability. Publishing is one thing, but our ability to execute at the published rate is also quite critical to really grow the financial market. And it looks like ability to trade is really not there from what this graph is telling us. Now, if you move to the next page, it then throws a bit more light on what I meant by capital controls and the exchange rate regime and all those other things that makes it very difficult for a foreign investor who needs to move money into Africa to be willing to move money into Africa. Out of the 17 countries that were surveyed, only 2 countries actually have a free floating currency, and those are South Africa and Zambia. Now, that then becomes a problem. So South Africa, yes, is a very open country and it has a lot of financial flows. Why? Because investors are able to observe the price of their product at any particular time, especially foreign investors who put their money in the South African investment opportunity. Now, you could see that also that a lot of the countries are clustered around an intermediate exchange regime. I mean, basically what that means is that it's anything between a fixed regime and something that seems to be floating. The problem you will have with that is that you will not be able to determine how activities of regulators will change the price of the currency, and therefore you may be subjected to significant shocks that models are unable to predict. And in the absence of that, a couple of things happen. One is that investment flows into the various countries are reduced significantly relative to a place like South Africa. Number two is that you will never be able to build a curve, or your financial products will always be limited to the very short term, where people are able to forecast the behavior of regulators or whoever can impact the exchange regime of the country. At this point, I would want us to take one or two questions. So again, I will hand over to Danae. There are a few questions that we would want to discuss before we move on to the next pillar.
Thank you, George. So this is the time to ask our audience a question. We heard George talk about access to international capital controls. So how concerning do you think a lack of access to international capital is for businesses across Africa? So now it's your chance to vote and give us a score of 1 to 5, where 1 means no concern and 5 is a great concern. So we'll give you a few moments to vote, and we'll wait to share the results with you all. Thank you. So you can see the results. Most of you seem to think that it is a concern, that some of you think it's a great concern, in fact. So if we sum the number of responses for 4s and 5s, that sums up to 77%. So 77% of you think it is a very great concern, or a great concern that in terms of the lack of access to international capital. And that is something that we found very much in the index survey as well, and that speaks to the result that George was talking about as well. George, I don't know if you have anything to add to when you see how our audience has responded before we move on to pillar 3 as well.
So I think, I mean, this is it's quite, I mean, it's something that is in line with the views that we've always shared, that one of the key things is that, yes, Africa can mobilize a lot of funding internally, and we need to do everything we can to actually mobilize that. But at the end of the day, there's 50 to 60 billion gap in terms of infrastructure funding that is required for the development of the continent for the next 10 years. We could supplement internal funding with external funding. And I mean, we've seen in the index that we are not doing as much as we want to do. And that is also reflected in the votes, that it's really a concern by all stakeholders. So it's quite interesting, and it all comes together.
Okay, thank you, George. And I think now we can move back to the presentation, and I'll hand over to George again to take us through Pillar 3.
So thank you, Danae, once again. So on Pillar 3, we try to assess transparency on the market. So transparency from a financial regulation and financial stability regulation perspective, transparency from a tax environment perspective. So there, some of the things we looked at was the existence of tax treaties between different African countries, and to also assess whether it's like an investor does a transaction in one country, how easy is it to offset their tax obligations across the countries, and how important is it for the investor. We also looked at the issues of minority protection. We looked at reporting and accounting, financial information availability, corporate action, and the existence of credit rating. I think, as you can see from the graph, this is actually one of the pillars where the whole continent actually did very well. And we can see almost 75% of countries surveyed moved above, or actually moved above the midpoint of 400 against a benchmark of 800, which is quite unusual compared to the other markets. And I think in the index research, it also came out that certain countries have actually done very, very well in cementing transparency across the various markets. So we talk about Mauritius and Nigeria, where a lot of significant reforms have been done to make the market more transparent. And then you have others following. I think a couple of things are important to note. So one of them has to do with reporting standards and accounting for transactions within, let's say, the equity market or within the derivative market in the various financial markets across Africa. One observation is that that there is no synchronization of regulation across the continent. And it tends to take a very long time for the continent to catch up with the evolution of regulation. So if you look at the main presentation, not this one, but the main index write-up, you actually find out that a lot of the countries in Africa are still on Basel II, for example, with a couple of them on Basel I. And all that just doesn't foster the ability to compare valuations across different markets. It's also quite interesting to observe that there is still room for improvement when it comes to financial information availability perspective. And this is about various economic data that normally comes out of either the debt management office or from the central bank. So there is a form of information that is shared with the market, but in some countries the regularity doesn't come through quite strongly. So, and you can see that in some of the countries where you see this kind of pattern prevailing. But overall, I think this is one pillar where the continent really did very well. If you move to the next page, where it then talks about the extent to which Africa's liquidity has been boosted by more and more private sector-led transparency. So how many corporates, for example, on the continent and in different countries are rated by reputable organizations. And again, there, if you strip South Africa out, there is a bit of a struggle to find enough rating on the continent. And if you calculate the number of ratings relative to the number of corporate bonds or equities listed on the continent, it falls far short of what should be expected. And again, after South Africa, you see Mauritius and Nigeria actually doing very, very well in terms of promoting companies to get their own independent private sector-led ratings. It's also important to highlight something about two markets which, I mean, currently have very minimal companies being rated, and but they have a very high liquidity from a financial transactions perspective. And these are Egypt and Kenya. So as we saw in the previous page, Egypt and Kenya have very impressive liquidity, but they've been able to achieve that without rating of corporates and other entities. And I guess the point to make there is that if these two countries have ratings equivalent to a South Africa or a Mauritius, you could see that their liquidity will actually shoot up significantly. And these are some of the insights that we are beginning to discuss with various policy makers to see how best companies can be motivated to actually bring more transparency, to bring more liquidity that tends to help the whole market to actually grow. And on that note, I would also want us to take a couple of polls. Danae, if you are ready, can we have the questions up?
Yes, so the next question is about the regulatory environment in African markets. So George has taken us through the tax and regulatory environment through market transparency. How do you, the audience, see that? Do you see an improvement in the regulatory environment in African markets? And again, it's you can give a score from 1 to 5 in the same way that we had the other question, where 1 is no improvement and 5 is great improvement. So how do you see the regulatory environment changing in African markets? And we're aware that we're grouping them all together, and of course there will be different opinions on different markets, but in terms of the continent as a whole, as George has taken us through the different markets there, how do you see the regulatory environment changing? So we'll give you a minute to give us your answers to that, and then we will share the results. So here you can see the results fairly in the middle pack, although more people seem to think that there is more of an improvement. 42% of you said that it's closer to some improvement or good improvement, and that is suggesting that it might be that we're not where we want to be yet, but there is some improvement going on. George, do you have any comments to add before we move on to the next pillar?
So I think, I mean, what I would like to add is sometimes when you also look at the regional blocks, what we also find coming through quite strongly is that the SADC areas tend to work in concert when it comes to regulations around the financial market. So at some point, it will be interesting to actually see the breakdown per region, and you actually find out, I may risk forecasting that SADC will do much more in terms of improving regulatory environment than the other regional blocks where we haven't seen much work from a regulation perspective in terms of countries working together.
Thank you, George. So moving on to the next pillar then, that is pillar 4. And that is the capacity of local investors. So as I said in the beginning when I was presenting the pillars, this was actually the one that we identified as the greatest area for improvement for the index as a whole. So there are the 2 top scoring countries that you can see there, South Africa and Namibia. that between them average 97 out of 100, so that's really quite high. But beyond that, the average for the other countries is just 22. So it is a very skewed indicator. And respondents to our survey said that increasing the range of assets for local investors and boosting the education around financial markets is the key to developing this sector and developing the capacity of local investors. So the indicators that we've looked at for this pillar are the assets under management for pension funds and also the assets for insurance funds in per capita terms and also as a ratio with the domestically listed assets. Now, what we saw was because GDP was growing very fast, Africa was developing, the value of those assets grew quite strongly. So between 2008 and 2015, the value of pension assets across Africa, across the countries that we track, increased by over 81 billion in that period. And insurance assets grew by 65 billion in the same period. But since then, we've seen some depreciation in the value of the assets because of low commodity prices, currency depreciation. So since then, if we look at just the change in 2015, most countries have seen the value of the assets fall. So the value of pension fund assets in the index countries, for example, fell by $113 billion, while the value of insurance assets fell by $25 billion in 2014 to 2015. And there are some exceptions to that. One exception is Ghana, which was the one that saw the value of assets grow more strongly. So pension assets grew by over 50% in 2015. But again, that was not so much an issue of valuation increasing. It was more an issue of the asset base because of regulations increasing the participation of informal sector firms to the pensions assets. But in terms of valuation, most countries, particularly the commodity exporters, saw a fall in the value of the assets. But when we look at how the index is constructed here, so South Africa and Namibia are really at the top, they're outliers. Why is that? So we can see at the pension and insurance fund assets and as a share of the total value of bonds and equities listed here. So in South Africa, for example, the pension fund assets per capita is $7,800. That is really an outlier. Now, in our methodology in the index, we have accounted for outliers. So the score that you see here for South Africa, it's still accounting for it being an outlier. So you can imagine what the skew would have been if we hadn't accounted for that. And for Namibia as well, it ranks second. It has a score of 94. And the value of pension assets totaled 14.4 billion in 2015. And this is lower than the index average as a whole, which is 46 billion. But in per capita terms, it is very high. So around $4,200 against an average of around $1,100 for the rest of the countries. So in per capita terms, that's what's really boosting Namibia's performance here. And you can see that also as a ratio of the local investment assets to listed assets, it is very high at 99%. But this is also partly the result of the locally listed assets being very low as a share of GDP. They're around 24%. And also it's because there is a lack of asset availability, and most of the assets are concentrated. They are held by buy and hold investors, which means that the turnover is very low. So even though you have a lot of assets held by local investors in Namibia, it's not a very liquid, there's not very high turnover. Turnover was just 1 billion in 2016, and that's against 2.9 trillion in South Africa. So you can see there that local investors in Namibia are pushed towards accessing international markets to find more liquid assets to hold. So that is something that we've observed, and that is something that affects Namibia's total score on the index. So while it's doing very well in this indicator, it's doing well overall in the index as well, but not as well as this indicator might suggest. Then pillar 5, we looked at the macroeconomic opportunity, and there one of the main factors, of course, is economic growth, the economic potential of different economies, and Africa is a continent that is seen from the outside and from Africa itself as a continent that is very fast growing, that offers a lot of opportunity. But actually, how important is that when we look at capital markets development? Are investors going to put the money into it? What are the other things that they look at? So beyond GDP growth, which is something that has slowed over the past years. So in 2013, GDP growth across the continent as a whole was 4.2%. In 2016, it was 2.4%. So quite a decrease, and that's because of the decline in oil and commodity prices. Also, as the global monetary cycle is tightening in the advanced world and returns are becoming higher, capital is shifting back to those advanced economies. And some countries have been hit by idiosyncratic shocks as well. Nigeria and Botswana were the only countries to actually experience negative growth since 2013, minus 1.5% in Nigeria and minus 1.7% in Botswana. But other economies have also faced some difficulties, and there are the idiosyncratic shocks that I mentioned. But some economies are still growing very fast. So that's so much about GDP growth. We also looked at the living standards, so the level of development. That is obviously a sub-pillar or sub-indicator where economies like South Africa, Mauritius, Seychelles are doing very well, the dark green block here in the chart that you see. And there were basically three key themes that we looked at when we assess the macroeconomic opportunity. So one is economic performance, and that's where we look at the things I just mentioned, such as growth, such as living standards. We also looked at export competitiveness, and I will move into more detail on this. The second theme that we looked at were financial risks. So what are the debt levels? What is the strength of the balance sheets? How resilient is the financial sector? And then the third theme that we looked at is macro transparency. So it's all well to say that Africa is growing very fast or that certain economies have strong economic opportunities, but how do we actually know that? How often do they release data on macroeconomic indicators? How do they communicate budget and policy changes? What are the data standards? So these were the three key themes that we looked at in this pillar. And I mentioned about the export competitiveness, and this particular indicator that we looked at as part of the pillar looks at not just the export market share, where, as you would expect, the biggest economies in the continent like South Africa and Nigeria, but also some that have strong ties to other economies like Morocco, Egypt, very reliant on exports, have high export market share. But we also looked at the export share growth, and some of the economies that are growing from a very low base are seeing very strong performance there. So for example, Ghana is the outlier here. It increased its export market share by over 166% in the past 5 years. And that is showing very significant improvements in its competitiveness. But overall, it's easy to grow that fast from a low base. Ghana's market share remains at 0.02% globally. So there is room for improvement there. And we see that as an indicator that is important to track as we keep doing this index from year to year. And then finally, our sixth pillar, that is about the legality and enforceability of standard financial markets master agreements. So we looked at various agreements there. What we found in our survey is that investors have sought higher returns in Africa compared to developed markets where returns have been low. But in order to actually follow through beyond the interest level and actually follow through with the investments, the success of this policy to attract foreign investment depends very heavily on the legal and regulatory certainty that investors can feel when they actually make the decision to invest. So we looked at the collateral and netting and set-off positions across countries. We looked at the strength of insolvency frameworks and the adoption of standard financial markets agreements. So there we looked at the International Swaps and Derivatives Association Market Agreement. We looked at the Global Master Repurchase Agreement and the Global Master Securities Lending Agreement. These were the agreements that we looked at. And the ISDA, for example, it's designed to enable over-the-counter derivatives to be documented well, and the netting and set-off positions to be enforced. The GMRA and GMSLA are global agreements on cross-border repos and securities lending. So we looked at these agreements, and South Africa is the only country where both the netting and set-off and collateral positions are enforced, and the ISDA master capital agreements are recognized and implemented. So Mauritius as well has a very strong regulatory and enforceability framework. So it's agreements might be in place, but it's also about how easy it is for countries to enforce them and what kind of resources they have to do that. And that's where we found it to be very uneven. We have found big variation. And also in terms of the policy prescriptions and what people in our survey responded, it's also about not trying to enforce agreements too fast because of the resources that might be lacking to do that. So it is about setting the framework for it. So Mauritius ranked second in that. It had a score of 93 out of 100. There was limited recognition of GMSLA, which is why it didn't get the full scores. But some of the lower scoring countries that you see there, Egypt, Ethiopia, Morocco, they didn't have sufficient recognition of the use of these agreements. So that's why they get a lower score. And then, as I mentioned, we also looked at the insolvency frameworks. So this is looking at the time, the cost, the outcome of the insolvency proceedings. And South Africa and Rwanda did very well in this indicator because they have rules to discourage lenders from issuing high-risk loans, and also a process of allowing the creditors to recover parts of their investments in case of insolvencies. Ghana did not do so well in that indicator. It was the weakest because even though it is part of the international standard master agreements, it fails to resolve insolvency, particularly in terms of the rights of the creditors and the recovery costs for them in the case of insolvency. And here in this slide, you see in a bit more detail the enforceability and the recognition of these individual agreements that I was mentioning before. So South Africa, where netting and the collateral position is enforced, some other economies as well that see that, Ghana, Botswana, Mauritius, Zambia, Kenya, and Rwanda. But then in the rest, you see that neither position is enforced. And when we look at the individual international financial master agreements, again, South Africa and Mauritius see those well recognized, but there are some that it is not recognized at all, or there is limited use for these agreements. So that concludes our analysis of this specific and detailed going into the indicators for each of the pillars. And now we would like to ask you in terms of some more questions of how we might want to improve the index. So we received some questions throughout the course of this presentation in terms of why have you not included country X, why have you not included Zimbabwe, why have you not looked at this factor? So we want to ask you, at what do you think the things are to improve the index? So I will hand over to George to manage that, but the first question is, which areas do you think we should expand to? And George will take you through the options there.
Thank you, Danae. So this first question is talking about other pillars that probably we need to be looking at and taking a forward-looking approach to the development of the financial market, and also probably issues that are more pertinent to the Africa situation than you will find elsewhere. So in terms of the things to consider in the next edition of the index, we have SME financing, we have cryptocurrency, so things like Bitcoin and the rest. And then, do we believe that we need to also add green securities? We would be very happy to hear your feedback. So we give you the next 1 minute to tell us what you think should be included in the index. Okay, so I mean, this is really interesting. We have a significant number of people actually going for SME financing, followed by green securities, and then the last one being cryptocurrencies. I mean, it's quite interesting, and I think it all links everything together in terms of what we believe will be the growth engine of Africa as a continent. And I think it goes without saying that SMEs are going to be a very important segment to actually power the growth that Africa expects. And the question really is, have we done enough from an innovation perspective in financing and funding SME activities? It looks like from what the audience or the people who have dialed in are saying, we haven't, and we therefore need to look at it critically. The next one is green security, so that is also quite interesting, and we've seen a couple of them actually coming up in the South African environment and a couple of other countries as well, but definitely something that we need to give more attention to from a financial market development perspective. And then the last one, it's quite surprising to me, to be honest, and it appears that from an Africa perspective, we don't see cryptocurrencies as a key driver of financial market development going forward. And one part of it is understandable because probably the regulatory framework is not yet developed to the extent where you can manage cryptocurrencies. And therefore, probably it's not a priority now, but it's maybe something that we should look at into the future. Danae, do you have any comments on this one?
I don't, but we have a comment from the audience saying that perhaps it's not cryptocurrencies that would be interesting, but more the blockchain technology and the development and its application across the continent. So that might be something that would be interesting for us to look at as we progress with the index, and also as blockchain technology becomes more and more important to see its role in Africa. So not so much cryptocurrencies, but the technology itself and how it can be applied.
Okay. All right. Thank you very much. Can we go to the next question?
Yes. So we're going to the next and final poll question now, which is, which new country or countries do you think we should add to the index? So you can choose more than one here, and I'll leave George to take you through the options and through our rationale for thinking we should be expanding the index to more.
Thank you. So the original 17 countries were based on the opportunity and interest really from investors. And it will really be exciting to know which next 2-3 countries should actually be added to the index. So I would encourage participants, please go ahead. You can choose more than 2-3. If possible, limit it to your top 3. We have the next minute to do that. Okay, so a significant number of us really going for Angola, and again, that is not a surprise. Sorry about that. It's not a surprise given the prominence of Angola on the African continent in terms of share GDP size, contribution to the commodity basket on the continent. And that's followed by Tunisia as well. I think we need a stronger representation from the Northern Africa region, followed by Cameroon, and obviously Cameroon being also a significant part of the whole West African bloc and the CFA zone, I think it becomes quite critical. The surprising one is actually DRC. And probably if we go back to the real investment selection criteria, on one side, there is a lot of opportunity, but on the other side, really, as an investor, you then struggle because of the structure of the economy, the structure of the market, in spite of the opportunity, and therefore it becomes a lower priority. So it looks like from the audience, it's Angola and Cameroon and Tunisia who are almost in a bracket. So that will be considered. But thank you very much for the input into this.
Yes, really thank you everyone for your input as we plan to present next year's index and to enhance it. We now have a few minutes left and we'd like to take your questions. So you can send these through the webinar system. And we have already one question from the audience. I think it's one for you, George. It was about Pillar 3 on the regulatory environment. And it says IFRS 9 kicks in by January 2018. So how will this impact in the shift the impairment in how impairment is recognized and reported on the performance of financial assets in Africa?
Yeah, thank you very much for the question. So I think that is a very big topic currently across the continent, and almost all regulators are very busy. I think from our perspective, this should be one of the regulations where regulators are really acting in concert. The initial view is that it's going to have a significant impact on profitability and income across particularly the banking sector. But the positive side to it really is about, it's going to be about leveling the playing field and the ease of comparing a financial stock in one country to another, and even comparing beyond Africa, because this is really a global regulation which is being implemented. So I think it's going to be a very interesting landscape from next year. Initial views, this is going to have a significant impact on some income statement and therefore balance sheet. But the positive side is that potentially makes the market more transparent, and on the back of that, we see more flows into Africa.
Okay, thank you, George. We don't have any more questions from the audience at this stage, and we are coming towards the end. So thank you very much all for joining us. Please sign up to the list to receive further information about next year's index and be part of the Barclays Africa Group Financial Markets Index community. And we do look forward to hearing from you as well, to engage with you in terms of the results of the index, what you found surprising, what you think should be covered more, and any views that you have. If you want to take part in the survey that we will be running next year, we will be very welcome to be engaged in this project. So thank you all very much for joining us.
Thank you.